All right, welcome back to View from the Ranch. Got my chief investment officer and top bunny,
Easter Bunny.
Brad Tremateri.
Hello, Greg. Not only am I sporting my lovely Easter outfit with my bunny ears and my bunny glasses, due to the continued shutdown of DHS, which should hopefully be funded shortly, I do still have a partial shutdown beard going as well. Yeah, you know.
Brought the beard back.
Hopefully this can be shaved by next week. It's getting a little annoying.
Yeah.
Just like the market.
It's been a rough market so far. I mean, at the end of the day, it seems like it would have been a lot worse than what actually the results have been, right? I mean, it's been pretty volatile, almost had a 10% correction this first quarter, which happens, right? I mean, I think I always notice that when you don't have a correction for a while, when you get one, people start to kind of flip out a little bit because they're not used to it. They have, forget that it happens like historically, like once a year, or maybe, lately, maybe once every 2 years, but it is a common thing to have a correction like we've seen.
Well, it is a midterm year, and we say odd things always happen during midterm years. So here we are after 2 decent months in the market and some exceptional data on our end that we've gotten basically flipped upside down in the month of March. And, this conflict in Iran, which I guess, there was always somewhat of a feeling to the market that this would happen, but I don't think people expected it to happen this quickly and to such an extent the first couple weeks of the conflict. But it's happened, and now we still think the worst is now behind us, but we have to work through it.
I mean, anything can happen, but it is probably one of the biggest chokeholds that we've seen as far as oil being disrupted. I mean, there's 20%, is that right, of the oil supply there?
Yeah, but this goes back. I mean, this is 2022 all over again. So it's almost the same timetable. The issues in Ukraine with Russia started the middle of February. This one started beginning of March. But it brings us back to a two-front war for the market, which is never good, where we're dealing with rising oil prices at the same time we're dealing with rising bond yields. And, they both put a pressure on the ultimate concern, which is inflation. And the main difference now, as we put out last month, there's a couple big differences between what we're going through now versus what we went through with Russia and Ukraine. We control this fighting. I mean, we can stop it any time or pull out whenever we want to. And also, even though inflation expectations have become elevated, we're still not sitting in front of a Fed that is extremely, extremely too late like we were in 2022. I mean, even going into the second month of the war in Ukraine, we were still doing massive quantitative easing, and they had not raised rates yet. So we were sitting in front of that whole massive explosion of rate increases in 2022. So at least we're not facing that same battle right now, which should help the overall market and economy.
Yeah, because the trend with interest rates have been lower. The Fed's been easing.
Mm-hmm.
Initially, they were expected to cut twice this year. What do you think?
History shows that we're really only forced, inflation is really only forced upon us during wars and rising oil prices. And we have them both. Again, just like 2022. You can go back to the early 70s with Vietnam and, the embargoes that we had. It's so interesting of how those two major dynamics control the price action of basically everyday life.
I mean, I think most people are just discounting the fact that this is, dare I say, transitory inflation. And we haven't heard anybody say that again, but like certainly people are feeling it, like, at the gas pumps. I mean, and some food prices are going up. I mean, you're seeing a spike in these things. It's just a matter of how long does this last, and can you just move past it?
We're seeing a spike in daily, usage of commodities. We're seeing a spike in services, but on the other side, we're still seeing a large amount of deflation in the shelter real estate rental market, which is a major component. So unless we're getting that explosion as well in the shelter component because of the size that it makes up of CPI, it's really, they should offset each other somewhat. But as we've talked about before, and as I see you put in your notes, long-term inflation remains well anchored. I mean, it's not like it was in 2022.
We're not printing $5 trillion extra dollars too.
I'm not sure about that. I mean, we never know what they're doing at the Treasury and the Fed. But the one thing that Powell keeps missing, and I guess a lot of the Fed keeps missing, is that things remain well anchored. Sure, they can get away from us, especially with what's going on now. But I just don't see this conflict lasting forever. Mm-hmm. And especially being a midterm year, it doesn't do Republicans any benefit to be involved in a massive operation like this.
Yeah.
So
he's going to do what he needs to do to get the markets in.
And the oil factor isn't really a factor for us. It's a factor for the rest of the world. I mean, we export more oil than we use. So, I mean, I guess somewhat it's a benefit to us because we're making more money, but it's the explosion in prices that you're seeing in foreign countries, that you're seeing in Europe and parts of Asia where they don't have the ability to produce their own resources. So, you look at the spread between WTI crude and Brent, which Brent is more used on the foreign market. You can see that the Brent prices are elevated relative to what WTI is. And they'll drop. We've seen enough of it so far. When good news comes out, they drop quickly. But also after President Trump's speech on Wednesday, we did see oil spike again on Thursday. So good thing is on Thursday, the market came all the way back from being down early in the morning, which hopefully the market's starting to look past some of this.
And Thursday was what, April 1st?
April 1st.
Yes.
April 2nd. April 2nd.
Okay.
Yeah.
So, yeah, lots of movements, and it just seems whatever oil is doing, that just, drives the market, whether it's up or down. And, of course, whatever comes out of President Trump's mouth is always, you never know what to expect, and it seems to drive markets pretty fast and pretty aggressively. I mean, oil has spiked. It went high as 110. Where was it, like at 30?
It's up to like 112, I think.
Okay.
Now,
but it's like a hockey stick.
Yeah, it's. I think we talked about it before. It's in backwardation though, whereas the front month or the current month future contract for crude is well above all its future contracts further out. So you can't have the price being higher. In some cases, 50-60% higher today than what, let's say, a year from now. Those things will even themselves out by, the future prices rising up or the current price coming back in. And as we saw with gold and silver, the way that they ran a couple months ago, commodities always blow off. They get to a point where it's just, okay, the price is so out of control that demand collapses. Well, different in oil, but the price demand there will collapse and it will come back in relatively quickly. It can't sustain itself up there at these levels based on the global ability to produce oil as well as other energy-based assets.
Yeah.
So,
unless maybe this continues on and
escalates more. Yeah, I mean, you could start seeing some major attacks on Iran oil facilities. I don't think the U.S. wants to go that far. I mean, they've shown they've blown up a lot of the country, but they've shown at least some reserve on certain things. So that's why getting a deal done sooner than later is hopeful. Let's get it done.
That's what we're kind of putting our expectations on, that there'll be some sort of a resolution to this in some manner. Certainly from a market standpoint, energy stocks have been the best performer in the first quarter. It seems more the defensive kinds of sectors, utilities, consumer staples have you're starting to see that shift from the Mag 7 and technology. Technology was one of the worst performing sectors. Although, of course, the longer term view of that is still quite bullish, but you're starting to see more rotation into value stocks, dividend paying stocks. The dividend index is positive for the year. So if you're a dividend investor, you're not taking the hits that you're seeing as if you were, in a more growth or tech heavy kind of a portfolio.
But I mean, that it's hard to trust those rotations because we've seen them a million times. And I have to say that the last couple of weeks, the rotation that we saw earlier in the year to non-cyclicals and how broad, the rest of the market got versus, say, financials and tech. I mean, that's come in, relatively quickly with Staples is a strange group. They're split. There's a lot of food companies in the Staples sector that pay great yields, but they all look like they're going out of business. They're not going to go out of business, but their share price acts like, they're never going to sell any more food for the rest of their duration of their business. At the same time, discretionary's bombed out. I mean, discretionary from a percentage of stocks above their 50-day moving average. I mean, it's extremely cheap. Doesn't mean it's going to go back up, but discretionary stocks are,
holding on to their wallets.
Are creating some value there. Tech was beaten up to a point, but it's begun to improve. And I think that trend in tech does start to turn around a little bit the main thing with tech is we're going into earnings seasons again, and we have to see the big hyperscalers, the big, AI data center plays, maybe show they're not going to spend $8 quadrillion, this quarter versus last quarter again, because this trend that we're seeing is very problematic. It does benefit certain areas, but especially with some of the Mag 7s, I mean, their capital expenditures have expanded at an astronomical rate the last couple of years.
And the Mag 7's down like 10%, I mean, maybe like 15 plus off of their high. I mean, they're trailing the stock market. Yeah. So you're starting to see that equal weighted S&P where it's not so dependent on, 7 stocks, 40% of.
But again, there's strange valuations there. Facebook or Meta at 17 times earnings, Microsoft at 22 times earnings, yet we're sitting there
at 50 times.
Yeah. We're sitting there with Walmart and Costco almost at 50 times earnings. There's different areas of the market that are getting discounted. But until the trend shows that, okay, these stocks are going to outperform for the long run, I think these rotations don't have a ton of life. I think they ultimately come back, especially in a down market. I think you start to believe that these big tech names or, big, retailers like Walmart provide some protection during a weaker market.
Yeah. Maybe it's just a temporary, I mean, they're great companies, but it's the psychology of investing. Most people, they want to buy these big tech names after they've rallied and they think they're just going to continue. And now that they're off 25%, people are holding on to their wallets, where really that's the opportunity where you maybe start dripping in a little bit by picking up a few shares when everybody else is selling. And that's always seems to be the better, that's discipline with investing. And that's the opportunities that we're trying to find.
One of the things I think, and this is a little bit off the beaten path, but, we've seen
the bunny path.
Got my basket here, by the way.
Did you bring me some candy?
You can have one egg.
Thank you. Appreciate that.
What a great partner I am.
Partner.
We've seen, because of the disruptions in oil prices and the dependency of foreign countries upon dislocation that prices cause within their own economies and currency reserves, that, for example, in March, last half of March, we saw Turkey sell up to $8 billion worth of gold to help, support their currency because of some of the issues going on with oil. I think a lot of the explosion that we saw in bond yields in March, I think, is a combination of oil, a combination of, some inflationary data that might be, a little bit of a pressure, but also countries selling U.S. treasuries as a need to raise cash to help support their economies. And you can also take that a step further when we look at a lot of our big mega cap S&P 500 stocks. I mean, these are the most liquid investments in the world, and they're the most owned investments in the world. So in the case of a need for a country, they will go out and sell. When you have a cash need, you're going to sell the most liquid assets you have because they're the easiest to sell. You get your money the quickest. You don't have to worry about aspects of trying to sell into an illiquid market. So some of the mechanics of what we've seen in certain areas of weakness in the pressure on bond yields, and even in gold. I mean, gold peaked on March 2nd. You would think in a global conflict like we're in, that gold would take off.
Right.
But there's downward pressure on it because other countries have other needs and don't have the natural resources that we have to be able to support themselves. So I think those pressures eventually go away. And that's why I think, some of the weakness that we've seen so far to start the year in certain areas of the market will, eventually stabilize and then be a leader coming back out.
Yeah. I mean, maybe there's opportunities for, with interest rates that have risen, 10%, right? Is that kind of what you've seen?
Yeah, somewhere around there. And
around
again,
there, yeah.
the one point on oil and interest rates is the market can handle higher oil. The economy can handle higher oil. The economy can handle higher interest rates. The problem with any of those is the market cannot handle excessive volatility. And especially, like you said, the hockey stick, the excessive price increase that comes that disrupts everything. The market wants stability. Whether what price or yield it's at, it really doesn't matter over the long run. It wants that stability. So, we look at the, there's a crude oil volatility index. And I put in our report in March that after the beginning of the conflict, that index spiked to a level that was 5 deviations above its, 20-year average. I mean, just a massive move. That volatility is unsustainable. It will come back down. The market and the economy just wants stability at the end of the day. And that's, getting out of the conflict would make things stable.
So maybe it's, if you're an investor, you've got some cash and you see some of these moves in interest rates or gold, is maybe not a bad time to start nibbling back in. I keep reading headlines of the 60-40 model portfolio is dead, 60% equities, 40% bonds, because bonds are slightly down for the year. And of course the S&P is slightly down for the year. And it's totally misleading, of course, but that just tells me there's opportunity there when the headlines are saying, it's dead, it's over. I mean, it's worked for decades. So, that 60-40 is something we use a lot for clients, but also it's what kind of stocks.
Yeah.
There's so many different stocks. You can't just put it
and
on
what kind of
S&P.
bonds too.
Yeah, exactly. So.
If I remember right, and I don't have the data perfectly in my head, but if we go back to 2022, last time we had some of the same issues we have today, I want to say that was really the first time in, I don't know how many years, maybe even decades, that we had the market down a certain percent and like the 10-year treasury down a certain percent. I mean, that's something you don't see too often. In 2022, as a product of the Fed having to be aggressive. Now, these rate increases, these yield spikes that we get, they're problematic too, but again, they're well anchored. So it's going to be interesting to see over the next month or two where yields are at, if there's any new issuance in bonds from corporations that are more attractive. We're not seeing them like we did before. So it just tells me that this move in yields is still going to be well contained. It's not going to run away from us.
And you can see that a little bit of confirmation with the outperformance of small and mid-cap stocks, that generally that's a trade that is betting on lower interest rates or more stable interest rates because of the cost of borrowing for some of these smaller companies.
Well, it's the rotation.
Yeah,
it's the rotation that we see.
Utility stocks are up too, which is pretty interest rate sensitive. So
one thing I will say is we go back and talk about the big tech names that are beaten up, and all this has to come to is spending on AI and building out these data centers and putting, billions of dollars inside of these things to be able to run everything. Yet utilities are up, and over the past, 2-3 years, utilities have acted like, what they normally do as a non-cyclical, somewhat as a bond proxy, but they also have, at least the ones we own, a growth factor attached to them because of what's going on with all this demand for future energy, whether it's restarting old nuclear plants or, partnering with Amazon and to build an individual, basically power substation next to a massive data center. So the growth that we're seeing in utilities also says, hey, there's really not something we need to be concerned about yet as far as AI and data centers go. The demand remains. So that helps put somewhat of a floor too underneath utilities right now, because they've acted extremely well. Even this month with yields going up, they should have faltered, but they haven't. So there's another factor there that's driving.
I really feel like it's the sweet spot. I mean, we're pretty big. Most of our purchases, like of stocks lately, seems to be leaning more towards that utility sector, and it's done well for us with being defensive, being the energy needs that we have for all these data centers. I mean, it seems like a no-brainer, but I mean, of course, anything can happen, but it's been a sweet spot for us that I think,
and we go back and we look at like some of the nuclear plays that were the darlings last year. They have not, they've all been decimated and have not been able to resurrect themselves back to what they were. So where that might be the future, it's still a ways off.
Seems like the hardware, the resources for AI versus software. I mean, there was a trend that started last year where software stocks were under pressure because of AI. Do you see that continuing? Or
I think there'll be some compression there, but I don't, I think it's more for the ancillary players in the space that don't have, diversity of product. You can look at companies like Microsoft and Salesforce, Oracle,
Adobe.
But you look at a bigger player like a Microsoft, it's much more diversified than just software at this point in time. But you look at Adobe, I mean, Adobe is excessively cheap on a price basis. I'm not sure it's there on an earnings basis yet, but is AI going to be able to cannibalize their product moving forward? That's an unknown. So we haven't owned it for a couple years. I keep looking at it. The software sector, it was one step forward, two steps back for the most of this year. Now it seems to be getting, hopefully 1 and 1, and it can start to build itself. But there's some longer term concerns there for some ancillary players that I don't think you chase much of the sector at this point, even as cheap as some of it looks.
So financials have taken a hit this year. There's another headline that's kind of getting overwritten by what's going on in Iran is this private credit scare. You have a company like Blue Owl that specializes in these funds of private credit, and all their investors are taking their money out. It seems to be like the headlines are kind of overblown with it, and people are panicking because they're saying that things are fine. And what's your take on that? I mean, is that something that, of course, we're going to be watching, but is that something that's on your radar for concern?
I would hate to see what would happen in this digital age and social media age today if the issues of the financial crisis and everything that was leading up to it occurred now. I mean, it would be a bloodbath every day on Twitter and Facebook and however else other people communicate. It's the end of the world. Everything's going to collapse. Back then, yes, there's a lot bigger problems. And I think what we're seeing with private credit is, there's some concern there, but I think it's at this point pretty well contained. Blackstone, your KKR, your Carlyle Group, and some of the other larger asset alternative managers have come in price, but there's not the stress that we're seeing on their books. You have a lot of, again, like with software, a lot of these smaller ancillary players that have realized, okay, we can run in and buy all this credit up from these, private companies, package it and sell it back off to people.
And that's grown, right? That whole market was pretty small versus it's really boomed because people wanted that higher interest rate. Just said, hey, I'm getting 9 or 10 or 12%, and not really concerned what's underneath. Yeah. So, I mean, that to me itself is like, if you're at the back end of that cycle and everybody's going wild trying to get more and more credit and participate in that, I mean, that is concerning. I don't know, it's hard to gauge whether that all blows up or not, but certainly the headlines are kind of
I can tell people we're not going to invest in them.
Yeah.
And I was at a CIO conference in December, and a very interesting conference. There's only about 50 of us that were invited, and we would sit down and meet with all these companies. And, I'd probably say out of the 20 companies we met with, 15 of them were either talking to us about private equity or private credit. And the one thing that really sticks out as a red flag, granted, we already know you don't have liquidity in these products. You don't really know exactly what's in there most of the time. The thing that stuck out to me is that they base you're now an accredited investor if you can invest $25,000 into these products. Yeah. At least the companies that, we sat with, which were pretty well-known companies. And anytime I think you lower that barrier of entry in something like this, it's just a big red X. It just doesn't seem correct when you're trying to pull in people with $25,000 into something that's illiquid. So there'll be companies that blow up just like, with software, but those companies, I don't think this leverage is nearly what we dealt with.
It's not like the big like financial institutes.
It's nothing like what we saw in 2008. Okay. I mean, you think about, it's just private credit. We're not talking about default swaps or other types of collateralized debt obligations that were paying 100-to-1 leverage. So there'll be some problems that I'm sure will come along with individual companies, and there'll be some pressure on the financial sector, but I don't think it's anything to worry about losing sleep over. And I hope it don't sound like Jim Cramer saying don't get out of Bear Stearns in 2007. But for now, I wouldn't be concerned about it that much.
Okay.
It's just something, again, in the society that we live with social media and the able to, people always trying to get ahead of the game. They're going to sit there and give you the TMZ version on a lot of stuff saying it's the end of the world. It's not. The sun's going to come up tomorrow. We just have to get through any problems that we have. The market worries. Like case in point with what we're going on in Iran. Once we find the exit ramp, everything's going to be fine. We just have got to get to that point. Once we find out, especially in a war, once you find out that you're quote unquote winning, which I'm not sure anybody wins in what's going on over there now. Once you find out that there's an end to it, something coming to an end, you get past it. I mean, most people really don't even realize that everything going on in Ukraine's been going on in Ukraine now for 4 years. Mm-hmm. The market's past it at this point in time.
Right.
So,
all right. So we're in April. What's your advice or your outlook going into April? What should investors be thinking about? What should they be looking for? And what's kind of historically April?
It's always been a good month. I mean, right? It used to always be the best month, but the last couple of years have been a little bit more difficult in April. Granted, last April was great, except the first 2 days of the month. I mean, we got destroyed with the Liberation Day collapse, but the rest of the month after April 4th was exceptionally strong. But April, next to November is usually the best month for the S&P 500 going back to 1950.
Was that when that 20% drop started for April? Did that start in March last year?
It started in March, but the first, April Liberation Day was on the 2nd. Trump gave the speech on April 2nd after the market closed. So that Thursday and Friday were nasty. Okay. I think we dropped, it was like 9% in 2 days, 8% in 2 days. And the S&P last April ended down like 0.5%, maybe 0.75%. So that marked the bottom, and then we rallied out of it.
Wonder how many people sold after that.
Well,
right? You missed that. I mean, that's the danger of getting emotional. We always say emotions can be one of your biggest expenses when it comes to investing, and it's like to really try to limit making emotional decisions.
The one thing that keeps me somewhat calm is that events like this happen where, again, our data at the end of February was, a lot of it was at all-time highs. And it's, talking about breadth and just overall market participation. Usually we're going to get some nasty divergence where our data gets weaker, yet prices keep going higher. And we had a little bit of that last year before the April debacle, but this year they both rolled over together. So there wasn't a divergence. So that usually tells me that you have an event like COVID. I mean, that's how COVID was. Now, COVID was nasty for a while, but we came back pretty quickly. 2018, when we started the tariff war with, China, things took a hit quickly together, but then we came back around, at least for the next until October of that year. 2010, you had some issues with the European debt crisis. Everything rolled over together, but it came back relatively quickly. So without those divergences, sure, we can keep having troubles, but we usually don't have troubles. And when you're at all-time highs, you tend to be pretty well contained. Doesn't mean you can't have a correction at 10%, but the longer-term damage remains well contained. So with April being, the second best historical month since 1950, and seeing where we're at now and what the forces are upon the markets, I think it's pretty easy to to get over those issues if things settle down. Today's Good Friday. We're in here Good Friday working, and the government's still working too, because they released the job numbers today for March, and they were plus 178,000. Much better than anybody expected. So a lot of the economy still looks good. It's the concern that these rising oil prices will, have a major inflation spike that will curb borrowing, lending, spending, and it will trickle down from there. I just don't think that's going to happen. So
you get a drop in interest rates, drop in oil, with everything else that looks positive, you could see a pretty good rally that could come out of this.
And
a lot of short covering too, right? There was a lot of people short going into this, which you saw like that last week when you just had these major shifts.
That's part of the data though too, is when we look at the investor models and you see how the levels of bulls versus bears or longs versus neutrals. We're in an area that technically should be bottom worthy. Mm-hmm. Now we've got to work through that, but
so you're calling the bottom?
No. I mean, it's just to us, this is still just a correction. Now, it could pull out to be something longer. I mean, midterm year we could expect something like this between now and say the middle of October normally. So we just have got to get through it. We're going to have better tax. Consumers are going to have more money in their pocket with their tax returns coming.
Is that working out? Have they pulled out the data? I mean, I know we were expecting that. I heard it was a little less, but I don't really.
It's still better than what we got before. Okay. So any dollar is good, and especially probably the people to middle and low income are going to get more back, as well as seniors. The real estate data, rentals, I mean, that stuff still is trending in the right direction as well. So you might get a wash versus expenses on the other side, but I don't think it's going to be excessively detrimental to the underlying economic data that we look at on a monthly basis. So, and the one thing I will say about just looking at the market in general is, we do go through these periods and you can tell how weak things are, how strong things are just by looking at the tape during the day and finding out, how the market trades in the morning versus the afternoon. And from the month of March, we had a couple good days, but a lot of the time the market would peak out in the morning and then keep selling off through the end of the day. That's not really the type of pattern we want. We want weakness to strength, even if we're down on the day. We want to see participation coming in. And we started to see that over the last week. I mean, yesterday was April 2nd. The S&P was down 60 points on the open, but closed up 7 or 8 points. It's one of the biggest spreads we've seen in the last 5 years.
That's what you want to see.
Yeah, from being at a low to closing up, over 1% from where you were to start the day. So you're getting people in there, and it just all's got to work together. What's going on overseas? What's going on with inflation, oil, interest rates? But I'm starting to pick up that the market is looking past that, and we're getting into the second half of earnings, or the second quarter of earnings in a few weeks. Usually the first quarter of the year, which most will be reporting in the first half, however they report what quarter it is, but the first quarter of the calendar year usually tends to be a better reporting quarter for companies. So we expect the data on earnings to still, and company performance to still be relatively strong. We're not seeing any weakness there at this point in time.
Okay.
So at the end of the day, and we think some of the weaker areas will bounce. Maybe some of the large areas like oil and will come back in, but overall, we should return to some form of normalcy, at least for this month. There's a potential for a seasonal, small, short-term seasonal top in May, but we'll talk about that next month.
Okay. Well, the market's always going to give us some noise to worry about, and you just, it's kind of times like this where you just have to stay focused, not make emotional decisions, stay focused on the long term. This too shall pass, and if anything changes, we'll certainly keep everybody posted. But for now, we're just going to stay the course. And actually, I think it's more of looking for opportunities. This is where you can make a little extra money if you can buy low, right, and sell high. I mean, that's the name of this game. So, all right. Well,
happy Easter, everybody.
Get you back to your hopping and
yep, I got to go deliver some more candy.
Nice. All right. Well, thanks for joining us. We'll see you next month. God bless.